Alright guys, starting. Chapter 14. Alright. Getting started, right? 14. Entry or entry. Strategy and strategic alliance. So basically how you enter a market. First one is fairly straightforward, and it's basic entry decisions. And within entry decisions, we got three main decisions. I will put them over here the journalist way. And the journalist way is, say, where to enter. In other words, which market you want to enter. Second one is when to enter. And the last one will be how much. The same as size. So, now we get to the first question, which is which markets? So which markets should you enter? For example, if you want to make an Asian expansion, would you enter Korea or Thailand or Taiwan? Okay, so this is the question of where. And number one, it depends on economic environment. You consider the economics. Is the economy doing well or not doing well? What's going on? Is it due for a recession? Is it in a depression? Whatever the problems are, you consider the economics side of it. Second one, you want to consider political. What's the politics? Is the government corrupt? Is it honest? Is it a revolutionary country? Some countries are usually unstable most of the times. Some countries are usually stable most of the times. So what about political stability and political complications? In general, this is the general rule over here. In general, whenever you're making a decision, business type of decision, you always focus on the benefits. You always look at, hey, what are the benefits of the decision, right? You also have to look at the costs. That one, again, is a basic principle of business decision making. So whenever you're making a business decision, you look at the benefit, you look at the cost, and what else? What else? Risks. You always want to look for every decision, whether it's finance, management, or in life, what are the risks associated with that particular decision. Back to the smaller factors over here, we'll look in simple things like size of the market. Let me do this, market size. Market size. Now, pay a little attention not to get confuse this size with this size. This is the size of the potential market. And this is the size of the entry. Are you going to enter the country big, or are you going to enter the country small? Are you going to enter slowly, step by step, or you're going to enter fast in a large size? So this is the size of your entry into the market. And this size is that of the market itself, okay? Another very important factor, this is all stuff that we've covered early on, is economic growth. Economic. Is the economy growing slowly or fast? So, does it have a fast economic growth? Fast economic growth will usually be better. Let's see what else. Current and future wealth of consumers, we just say consumer wealth. Are customers and consumers rich or not rich? You'd rather have a market with richer customers, okay? So consumer wealth. And we like to say present, not only their present wealth, how rich they are, but you also want to see their future wealth. Now, the difference between present and future date is the rate of economic growth, usually. Okay, so the economic growth will determine how much the future wealth will be larger or higher than the present wealth. Part of the wealth, which is almost the same, so if you want, you can put them together, or if you want, economically they're pretty much the same, is just living standards. Living standards. There's a little bit of a difference between your wealth and living standards. And living standards will be determined by wealth, will be also determined by income. Are these people making a lot of money or not a lot of money? Income. And there's one other thing which links these things, and that's debt. Debt. As in borrowing. Example of high standards of living where people are very poor will be America. In America, people are spending a lot of money on a lot of consumption things, yet they're relatively poor. They have very little accumulated wealth. They have very little savings. The average American's got less than 30 or 40,000 US dollars saved for retirement. And more than 90% of Americans have less than $5,000 in savings. So they practically have no wealth. Yeah, they got wealth like TV, like a laptop, like a camera. They got stuff, consumer stuff, but they're not really wealthy. We say in English that they're one paycheck away from bankruptcy. All right? If the paycheck doesn't come, they are bankrupt. Or they're one sickness away from bankruptcy. They get sick for just a short while and you're done, game over. But living standards in general, so you may have countries where they will have relatively low income, but at the same time they'll have zero debt, and people will be trying to save more. In other words, wealth is more determined by savings patterns. You accumulate wealth by saving. Okay, that's elementary economics. All right. Another very important factor, which is a lot bigger, is potential economic value. Well, let's call it potential value creation. If you are entering that particular market, are you going to be able to create good value for consumers? If you're going to be creating a lot of value for consumers, you as a business are going to be able to extract some of that value as a profit. If you're not creating a lot of value, most likely you're not going to be making a lot of profit. In other words, high creation of value means that you're going to be able to charge a higher price, okay? That's going to give you better strategic flexibility to keep price high and profitability higher for a small volume, or to keep price lower and expand volume. So you want to know, are you creating a lot of value for that market or not? And one of the key determinants will be local, we call it in English indigenous competition. Indigenous competition, local market. Is it saturated or not saturated? Example will be BMW trying and considering two markets, the Japanese market and the Bulgarian market. Japanese market being saturated by Japanese luxury automakers like Lexus, okay? And the Bulgarian market, which is bare naked and open and hungry. In other words, locally, you got little competition in Bulgaria and a lot of competition in Japan. The value proposition is better in Bulgaria than in Japan, all right? Because of local competition, which is almost non-existent on our home markets. You need to consider your core competencies. And the core competence of BMW will be superb engineering, but the Japanese will be superb engineers too, okay? So you don't have much of a competitive advantage or much of a different core competence over the Japanese, but you do have over Bulgarians. Next one will be unique resources. And special know-how. How to run a major operation like Metro, okay? You're all familiar with Metro. It's a big retailer. How you run an operation. You may have very special know-how how to run this type of a large-scale operation in a highly efficient manner. And this over here will be determining to a great degree your competitiveness. So, you want to determine how competitive you're going to be on that particular market. Do you have any specific unique resource? Do you have any special know-how? Do you have any core competence which differentiates you from the competition? For BMW, not much on the Japanese market, but an awful lot on the Russian market, okay? So, these are some of the things to consider. So, that's number one. Which markets? Now, we move on to the next one, which is when. We call it number two. timing of entry. And timing of entry could be, it's actually a term. They got it as a term. Early entry and late entry. Early entry basically means before the competition, and late entry basically means after the competition has already entered the market. And from these, you got the so-called first mover advantages. Is it with a dash? Yes. If you're an early entrant, you're gonna get or gain first mover advantages. And some of these are, let's try and see how we write them over here. Okay, I'm gonna put it here. Demand preemption. Demand preemption. You preempt, you probably need a dictionary over here. You preempt demand from competitors. You enter the market early. That's the only thing that consumers have, and consumers are buying it simply because there's nothing else to buy, because there is no competition, because you're first on the market. So early on, you take significant market share and consumers get to know you. So demand preemption. To preempt means to foresee that something might happen and you act upon that thing in advance, okay? In anticipation of something. Of course, if you're a first mover, one of the biggest advantages is that you're going to be able to sell very large volumes, so it's economies of scale. You're going to be able to expand rapidly with little competition, and sometimes you can gain a lot by keeping the price low and expanding the volumes significantly. And economies of scale provide or give you a significant cost advantage. So the second major advantage is a cost advantage coming from economies of scale. From cost advantage. And the third one is very interesting, called switching costs. Switching costs. Example will be in my home country, Bulgaria. We had at first only one telecom company. I'm talking about early on, more than 10, 15 years ago. We had only one telecom company, so you want to get a mobile, you sign up with them. And many people were signed up with them. Well, later on what happened was you got a second entrant. And that second entrant offered new, lower prices. And many people were thinking, well, everybody knows my old number, and I don't want to switch in the middle with a new number, because back then there weren't much regulations about it. You had to use a new number when you're switching your telecom carrier. So a lot of people chose not to switch because they're going to lose their number, okay? So I was exactly in the same position. When I came a little late into the market, I chose the second carrier. And when I chose the second carrier, I used it for about 3-4 years. A lot of people, I had a few hundred contacts who knew my number. And at that point, as I moved to Saudi Arabia and later on teach in Bahrain, I really didn't need the plan and the program and all the other things. But somehow I felt that switching to another carrier is going to be too much for me and losing the number and all the other thing. But, you know, as they tried to milk more money out of me, later on, by the third year, said, okay, I'm too sick and tired of you guys. I'm going to switch to significantly lower. In other words, the third competitor. So this will be example of switching costs. Another example of switching costs is right over here. I had a Chinese guy who actually we were running and jogging and exercising together. One day he says he lost his iPhone. And when I asked him, well, okay, so you're going to get yourself now, because we were talking with him that he likes Galaxy more, but he had the iPhone for 3 years now. He said, well, I lost all of my contacts with my iPhone. So I have to buy an iPhone again, and then he can use the web store, it's called the cloud, to sync up his contacts. He said he's going to lose all of his contacts if he switches to Galaxy. Okay? So for him, losing a few hundred contacts, which he has accumulated for the last 7 or 8 years, is too much. So he'd rather buy another iPhone. So, well, guess what? He bought iPhone 5. Okay? But he didn't really want to buy it. Okay? He would rather buy Galaxy, but he thought that the loss of a few hundred contacts is too much for him to bear. Okay? So it's an example of switching costs. And I can provide hundreds of examples, but don't want to do that. You got mechanics, you got repair shops, they got parts and all those, and then switching from one brand to another. You got to learn the new brand, you got to get the new spare parts and all the other things. Too many problems. And, however, if you choose or happen to be a second in the market, or late, we call late entrant, you get what's known as a second mover advantages. Second mover advantages are not advantages that accrue to the second entrant, but are advantages that accrue to the late entrant. So the third, the fourth, the fifth one would also get these. And some of these advantages are fairly straightforward. A major disadvantage of the first mover is that you have to educate the consumer about your product. So here you no consumer education. The consumer already knows what a smartphone is. They've already used it, they've seen it and everything else. You don't need to educate them about the benefits of smartphones or the benefits of, let's say, mobile phones. For example, my dad, I couldn't even convince him that he needs a mobile phone. Of course, he doesn't need. How could he possibly need it if he lived for 70 years? He lived without mobile phone. Obviously doesn't need one, okay? I mean, it's so common sense. So it takes a lot of education to get to the point where he'd say, okay, I'll just have one, it's gonna sit there if it's not going to cost me much money, okay? If it's on a voucher, it's just going to sit there, it's not going to cost him much money, but then he goes out, drinks, puts it in his pocket, goes this and that, and over time he gets to see, oh, it is very valuable. Same thing with internet. Of course, early on, he didn't need internet. Like, why would anybody use internet for anything? Again, it's the same logic. He lived 65 or 70 years without internet, just fine, okay? Well, today, 10 years later, he can't live without internet, of course. He's doing everything on the internet, whether it's the weather, it's the movies, or whatever that might be. Again, in other words, if you're the first in the market, you need to educate the consumers about your product and about the benefits of your product. Now, once the consumers are educated, then you don't need to educate them again about, now he's just looking between the best service. So that's a big one. Let's see what else we got. Lower risk. Lower risk. In general, the first mover, major disadvantage to the first mover is very high risk. He doesn't know if the market's going to take it, if the market's not going to take it, the market's going to like it, how you're going to educate the consumer, how the government's going to react, how other businesses are going to react. In general, you have high uncertainty. So the first mover advantage is associated not so much with risk as uncertainty. And for the first mover, the uncertainty is high. For the second and late movers, the uncertainty is relatively low. Okay? Because you already know how consumers think, how they behave, how they like the product, what they like about it, what they don't like about it, and all the other things. For example, you can try selling these huge screen mobiles. You think it's a great innovation, and consumers in Macau love them, and consumers in Bulgaria ignore them, okay? So here, it's just uncertainty about a product, okay? And in Bulgaria, these simply don't sell. You're not going to see anybody in Bulgaria carrying these huge mobiles. They just think they're too big, too cumbersome. They want them to be slimmer, and so on. So lower risk, and let's see what else. Yeah, that's pretty much it. Let's see number 3, where I'm going to write. Okay, I'm going to try over here. Number 3 will be scale of entry. So, number 1, which markets or where? Number 2, when? And number 3, scale of entry, and the same as size. Okay? And the size could be large. Let me see if this will be a little better marker. Large as in rapid. You could enter the market really fast and big, okay? You try to conquer the market as quickly as possible. You flood the market. You saturate the market. So that's the one way, we call it one strategy to the market. But this large and rapid is relatively risky. You can enter the market big, but you don't know how the consumers are going to react. Okay? The other one is, let's see if I want to get it large, flexibility, small. So, small or also slow. You can enter the market slowly, step by step. Here, the advantage is significant learning. If you're slow, enter in the market slowly, you learn and you see how the market reacts, you see what's going on. You can also learn about the government, you can also learn about the consumer, you can also learn about business practices. So this learning will make it less risky. Part of the large and rapid entry will mean that it's expensive. Expensive means you will need a large amount of capital to invest. So if you want to open 50 stores, you'll need a lot of capital to open 50 stores at the same time. If you're doing slow, you open one store, after 3 months you open a second store. As the first 2 stores make money, you take some of the profit, you open the third store. Now I have 3 stores, the 3 stores make money, you open the 4th store. So you use part of the profits to reinvest in the business, and that particular reinvestment lowers your overall initial investment in capital. So this one is relatively cheap in the sense of low capital investment. You're not going to invest large amount, you're going to invest a small amount, okay? The concepts associated with scale, the big major fundamental concepts, are known as strategic commitments. And commitment means what it says, you strategically commit to the market. Means once you make that particular decision, you cannot reverse and back out. And that's a major difference between a large scale and a small scale entry, is that the large scale entry usually means a strategic commitment to the point where you can't just back out. You say, well, if things don't work out, we're just going to leave the market. Well, if you open, let's say, 50 stores or 100 stores in the country, you can't just leave the market and abandon all of your investment. It's way too much to abandon. On the other hand, if you entered slow, you've made relatively little initial capital investment. So the strategic commitment depends on the investment of capital, or it's called capital investment. Did you make a large investment or small? And it depends significantly on the, it's called specificity of capital. How specific? And this specificity, if your capital is not in any way specific, but is a general type of capital, you can easily reverse your investment. So it depends on how easy you can reverse, as in get out of the investment. So strategic commitment will be when you have made a large investment and you can't get out of it. You can't reverse it. Girls, you keep talking, all right? Maybe soon you have to separate, right? Soon, okay? So, strategic commitment means you can't easily reverse your investment and get out of it. It's called stuck with it, okay? You're stuck with it. So, strategic commitment is very important, and you have to be careful, because strategic commitment later will mean or will imply a second big one, strategic flexibility. Strategic flexibility basically means the ability to enter new markets as they open up, the ability also to reverse and get out of a market. So, when you make a very large scale entry, you are taking usually you are becoming committed to the market, and one of the major disadvantages of a large entry is that you may lose flexibility. You may lose strategic flexibility in the sense that, oh, we're now entering, let's say, the French market. It's taken a lot of time, it's taken a lot of effort, it's taking a lot of capital, and we don't have resources, resources as capital and management skills and management time to enter the Italian market. So you may be a small or a mid-sized company and you got to choose, do we enter the French market or do we enter the Italian market? Which means that once you make a commitment to the one market, you don't have the resource or capability to enter soon the other market. So you lose strategic flexibility. So whenever you make an scale an entry, you have to consider, are you going to make a commitment or not? Are you going to be committed to the market? And how is it going to affect your flexibility? Is it going to limit your strategic flexibility or going to retain your flexibility? All right, let's see what else we got in here. Well, that's pretty much it. Section number 2. So, section number 1 is entry decision. Section number 2 is entry modes. And we got 6 entry modes, and I'll be covering them all. Number 1, exporting. Exporting is major advantage. Quick, easy, relatively straightforward. Quick, easy, straightforward, requires very little capital investment, okay? So exporting is usually the first step to enter a foreign market. You just ship the goods, okay? And now in modern days, over the last 10 or 15 years, it is not as complicated as it was exporting from Britain to Germany or from Germany to Britain. Now it's relatively easy, relatively straightforward to export practically anywhere in the world. So, very low cost, little capital investment is a major. Disadvantage, however, one of the major disadvantages is high transportation costs. Transporting a good from New Zealand all the way to here, for example, New Zealand butter, okay? Well, you made it in New Zealand, but shipping it from New Zealand to Thailand or to Germany is going to be quite expensive, okay? The shipping cost could be as much as the cost of the butter itself. So sometimes shipping or transportation could become expensive. You may also have tariffs. The government might not want you to compete like the European government. It has very high agricultural tariffs because for political reasons they want to protect their own farmers. As you were watching on those documentaries that I gave you, the United States will want to lower Jamaica's tariffs to 0, but it will keep its own tariffs very high, protecting its own farmers, okay? And that's one of the major problems to make any North and South American units together, is that Americans don't want to lower their tariffs on agriculture. Whenever Latin American countries raise the issues, nothing happens, okay? You got big politics and governments playing into this. So sometimes you just won't be able to because the government won't let you. When you're exporting, meaning producing at your home country, you might be missing some location economies. Yes, you gain economies of scale by producing at home but at the same time, you might be able to move production in some other country, and that other country could be making or producing a lot cheaper. As we saw, you can move your production to Indonesia, get the cost of production 10 times cheaper, you benefit from location economies. But if you're producing from home and exporting, you might not be able to gain location economies. And number 4, with exporting, sometimes you may have to deal with local sales, and marketing. Sometimes you may have to give it to local dealers. And sometimes dealing with local dealers isn't a good idea. Sometimes the local dealer will also have other products of some other competitor, okay? And in that particular case, they won't be committed to your product. For them, it's just another product, okay? You're, let's say, exporting video cameras, and you're trying to export your brand, and the local dealer will already have 4 brands, and he's going to now have brand number 5. He's not going to push your product very hard, okay? So sometimes the local sales and marketing will also not understand your product. They wouldn't know the benefit. They wouldn't see the benefits. They wouldn't care about your product. So this could be a major problem overall. Number 2 will be turnkey projects. In a turnkey project, you make turnkey project. You have a contract to create and build for the foreigner their operation from scratch. So you're, let's say, an oil company. Is an oil company, got the know-how, the knowledge, the experience. You're going to make, let's say, in Saudi Arabia or one of the oil exporting countries, you're going to make for them, and you're, I don't know, Shell or some other international company, British Petroleum, and you're going to make for them a refinery, okay? As you make for them a refinery, you build everything from scratch. They pay you big money, billions of dollars, possibly tens of billions of dollars to build a refinery, okay? So that's how you make money on your capital. That's how you make money on your know-how. In this particular case, we say that you capitalize on your know-how, or we say that you monetize your know-how. You have a knowledge, you have experience, you've done this for many, many decades, if you're British Petroleum, for 100 years, okay? And now you build one for them, and that's a major advantage. So we say that this gives you what's called a return on your know-how. You get a return, you make money on it. Nora, soon we'll have to separate you after the break, okay? All right, the turnkey project, the major advantage is that it's relatively risk. So, advantage, less risky. You build it for them, you train them, and then you hand it over to them, and they can do whatever they want to do. If you build it as your own, after 5 or 10 years, they can just steal it out of you through nationalization, or they can tax the hell out of you. They say, oh, punitive taxes, 60 or 80%. Like American or other foreign companies and oil companies in Venezuela, where the Venezuelan government says, we are going to tax 80% of their profits. In other words, they will have to pay us a lot more for stealing our oil. But Americans are saying, but we're paying for your oil. Okay, and say, but you're not paying enough. You're paying us $10 per barrel. $10 per barrel is a joke when oil is $120. You got to pay us a lot more, okay? So, they made the deal when oil was $20 on the market. And when oil is $20, when you pay the Venezuelans 10, it seems fair. But oil, having gone up from $20 in 2002 to $100 in 2008, these $10 don't seem fair to the Venezuelans. Even though they got a contract, they change the contract on you. Well, with the Turnkey project, you don't have this problem. It takes 2, 3, 4 years to build whatever you build. You sell it all to them, and when it's done, you get paid, and it's their problem. They do whatever they want to do. It's their plant. Yes?
Sorry, I cannot read the word. This word, yeah.
This one, advantage. A major advantage is that it's fairly less risky. Now, what is the disadvantage? One major disadvantage is that you have little or no long-term interest. No long-term. So this LT stands for long-term. No long-term interest. Well, this, if you think is a problem, and if you think you want a long-term interest, then the solution is known as minority stake. You take a 10% stake. You own 10% of it. So, partial solution is called minority stake. Okay, we'll own 1/3 of it. 33% will be our own, and 66. This one is disadvantage, is no long-term interest. And partial solution is, okay, we're going to take 30%. So if you take 30% ownership, meaning a minority stake, you will have some long-term interest. Another disadvantage is that you run the risk, it's a risk, that you will actually create a competitor. They say you can inadvertently, without planning, without wanting it, you create a competitor. That could happen, and it's a risk. You don't think of them as being smart and as being competent. They'll take your technology and they'll continue to develop it, but that would and could happen. And the other major risk is not just creating a competitor, but selling a competitive advantage. So, your know-how is the source of your competitive advantage. Your know-how is the core competence. That's what you're good at. And by giving them the whole technology, or at least giving them the material side, the machine, the equipment, you could possibly, again, knowing or not, you could potentially sell, again, unknowingly or unintentionally, your competitive advantage. If they learn your know-how, they could possibly, literally gain your competitive advantage. Them gaining your competitive advantage means that you're going to lose your competitive advantage. So you can create a vicious competitor out of it who could now be competing with you in other third markets around the world. All right, so we take a break and then we have our last lecture. Continue and finish as much as I can, okay?